Appreciate it. We have our in-house panel as well today. Paul Vigna from the Wall Street Journal and Fox Business senior correspondent Charlie Gasparino. Paul, you beat Charlie to set, so your comment first. Right. What do you think?
To get the zero off.
So are we catching a falling knife here?
I think it's surprising that you have not seen this in the market yet this year. You look at everything this year. I mean, fundamentals. I'm not talking about massage numbers. Fundamentals. You have had no profit growth. You have had no sales growth. You've had virtually no GDP growth. 1.5% through the first half of the year is nothing in terms of building a sustainable economy. You have stagnant wages. You have low consumer spending. You do not have any of the kind of signals, like Scott was just saying. Mm-hmm. You don't have any of the kind of signals that would say to you the market should be at all-time highs. I'm surprised we have not had this kind of a drop yet this year, so it's not a big surprise. The only surprise is the timing.
The Dow is down 407. I believe this is close to the low of the session here. It is the low of the session. So do you see this coming into a proper correction where we will see the Dow off 10% from its recent high?
Yes, I think
is that a
one
given?
Thing, usually when these things start, they have their own momentum, and they are going to go as far as they're going to go, and they usually overshoot. So a 10% drop in the Dow wouldn't surprise me at all. The S&P is a little further away, 3 or 4%, depending on what the numbers are right now. That'll probably get there, too, though. You have not had a correction in 3.5 years. This stock market, no one wants to hear, but it is extremely overbought. You've had 0% rates, forcing people into buying stocks.
I would just say, ask Paul, what do you think the psychological impact is if they don't raise rates this year?
You know, that's the really interesting thing, because the Fed minutes this week were really dovish, and the market took it as dovish. Right. Usually the market loves that. The market hated it this time.
Oh, interesting. Okay.
It was okay, so we're at the session low officially now. We're down about 2.5%.
I would just say this. I wish I could disagree with anything you said, but I can't. I mean, it's like, it is what it is. It is.
But is it just about, Charlie, there are so many moving parts. You've got interest rates. You've got the China deval story. You've got
it's all, there's not a lot of moving parts.
Why now? I mean, that's really the question.
No, there's not a lot of moving parts. There's a few moving parts, and the few moving parts
one story.
It's all one story. Yeah. China's economy is slowing down. Our economy is not doing that great. Right. We depend on them as a trading partner. That will hurt our economy.
Okay, so why are so many people zeroing in on the Federal Reserve and raising if it's going to be this or then?
That's a lot of it's journalists, but I would say this. The only thing that I think prevents a full-fledged correction here is if the psychological effect of the Fed not raising right now, because I think a lot of people are pricing that in. And by the way, don't discount BS psychological issues, because as we know, it shouldn't really mean that much that they raise 25 basis points, or they don't. But if they don't, you know, that's a signal to buy some stocks. But I will say this, and here's where it gets kind of dicey. And Mort Zuckerman in the Journal made the point today in his op-ed about the economy and just how slow it is, and that economic cycles run in 7 to 8 year cycles, right? And you generally come, we're hitting that, and suppose the economy is going into a recession.
Right. Look at the bond market. Look at gold. Right. Gold finally got out of bed this week.
And then what ammo do we have to prevent that? I mean, QE. Yeah. We're in very, and maybe the Fed has to raise just to give us some just give them some ammo. Like if
let
we go
Paul
into a
have the last word, and then I got to go.
We cut interest rates.
You had a Fed paper. I forget which of the regional Feds wrote it, but they came out and they said. This was, again, just some Fed researchers, but they said QE has had almost no effect on the economy. And I think that got a lot of people's attention. And then you combine that with the fact that the Fed itself in the minutes is saying, we're a little worried about this economy.
It had to have helped. It had to help at the margins. I don't think it's zero.
Yeah, no. Right. But I think you have a situation where the market was ignoring the reality because they thought the Fed was going to have their back.
Hey, guys, I want to point out this happened yesterday. We're seeing the sell-off accelerate. We've got the Dow off 400.
It could be a 500-point day today.
You think you're going to call for a 500-point deficit on the industrial average?
The market today looks so. Every time we started coming back, we would produce right after that losses even more. Right? I mean, this looks like it's.
Well, yesterday at this time, Charlie, we were seeing a little bit of light. Dow climbed about 70 points, and then right around 3 o'clock Eastern, it all fell apart, and we closed down yesterday, 335.
I'll tell you what, before I was about to walk up here, it was down 350, so that's down almost another 100 points. So, yeah, listen, it's got steam.
Yes.
The sell-off has got steam.
Paul, let me ask you this. What's the proper valuation for the U.S. stock market right now in terms of PE? Is that putting you on the spot? I'm sorry.
I knew that. I'd be running a hedge fund in Connecticut.
No, but come on. Everybody talks about proper, PE ratios and what the S&P is trading at.
My personal opinion is you have no real profit growth and you have no real sales growth. Mm-hmm. The market it's overvalued right now. Although what the proper level is for that, Lori, I don't know.
But when you have interest rates at zero, the proper level is put your money in stocks. right?
Well, you know, you have interest rates at zero. QE3 ended in October. The S&P is virtually where it was in October.
There you go. We got to leave it there.
Okay.
Paul, Charlie, thanks so much.